Hey folks, it's Dr. Rowe. I hope you're well. I wanted to tackle this subject because I think in the current climate there are opportunities, certainly in the United Kingdom at the moment, where certain markets are growing quite rapidly. Prices are going up or even above what asking price is. Part of this has been driven by the government's incentives to do with stamp duty, delaying that, and it's beneficial for people to buy before that stamp duty exemption period ends, so they save some money on deposit money, etc. So the market's pretty aggressive in that respect at the moment. And along with that backdrop has come the conversation, which has come up in the past, not like it's suddenly come up now, and that's to do with refinancing properties. So I've got some information I'm going to put up on the slide here with me now. And I just want to share with you, I'm not a financial advisor. This is not financial advice, so you have to go and seek independent financial advice. Let me just share with you just the facts about what happens when you do a refinance and just try and step back from it and look at it from a long-term perspective. So let me pull up some of my overlays here. This is the first one. Hopefully you can see that behind me. If anybody's watching live, give me a thumbs up that you can. And that is to show that initially what we've got, the first of the smaller ones here, which is that one there, that is your initial refinance. So you've bought the property, maybe 6 months later, you've done a refinance on it, and the red represents the mortgage from the company, which is 75% of the market value. And the green represents, in that example, the equity, the difference between the value of the property and the mortgage. And if I move my hand there, you can hopefully see that there, right? So that's 25% of that valuation. So you do that once. You set, maybe you do a fixed rate mortgage, maybe you don't. Again, that's a conversation to have with your broker. At the moment, that's what we're doing, we're fixing. And now you've got your cash flow on a monthly basis, and you may have extracted some of the capital you've put into this deal when you started. You may have extracted all of it, just depends on how that valuation came. Now let's fast forward 2-3 years, or maybe shorter, depending on how that market's moved. And now we go to the second one here, and that's where the property, oh, I've got a thumbs up, thank you, you can see this. That's where the property has gone up in value. Okay, so now we've got an increased value on the property. If you do nothing with it, then just be mindful that I've got a couple of lines here. So that top line there, that dashed line, represents the value of the property at the original valuation after refinance. Okay, just bear that in mind. Now, I could put, I don't know if I can show you this, I could put a line below that, which is this little red area here. It could be a second dashed line at the bottom of the green there, and that would remain the same. That would be your mortgage over that period if you do nothing. Okay, so I don't know if you can actually see my hand. Somebody give me a thumbs up to tell me if you can see the hand there, if you're watching live. Meaning the hand here represents what the actual property is, the mortgage is doing over that period. You've kept it the same. In other words, if it's a 100 grand property, £75,000 mortgage, it would stay the same there. Now watch what happens. When you refinance, you're basically increasing the level of borrowing on that property, and the green represents the equity at that point, the 25% in the property there. You've extracted anything out. Now, in theory, what you've done there is you've extracted the difference between that dashed line up to where the red mortgage ends there. That difference is what you've pulled out the property at that moment in time. If you then wait another 3, 4, 5, 6, 7 years, whatever, and it goes again, and now the value is up to here, the top of that mortgage down to the red dashed line is effectively what you're extracting out of that property in terms of gain as equity release. Why do people do it? Because they want to pull cash out of the property and they want to use it for something else. That's the process that people go through if they keep refinancing. Now let me introduce my points here. So each time you do this, your loan to value you're putting in place remains higher. So you've moved it from here, and now the loan. So with a refinance, each time at 75%, your loan to value will be 75% there. It'll be 75% there on this second one. I'm hoping this is showing up, by the way, and it'll be 75% there. Okay. So 1, 2, and 3 in this example here each time, whether it's 5 years down the line, 8 years down the line, you now have a 75% loan to value on that property. So keep that in the back of your minds. Also, because your mortgages have gone up, unless you've significantly changed the strategy or managed to increase that rental incomes coming in, the chances are the cash flow on the property will drop. Reason being, you've increased the mortgage, and because you've increased the mortgage, the cost of borrowing on a monthly basis has now gone up, which in theory will drop your cash flow unless you happen to have shifted to a much lower interest rate mortgage and you've increased the rents on the property. So the top end coming in minus that higher mortgage going out, you've managed to maintain or keep the cash flow there. So it could be the case. Most of the time, that's probably not going to be the case if you've done a big shift in the mortgage. And then, of course, we go to here, got a much bigger mortgage here than when we started back here. So unless your rents have gone up and the interest rates are really low, chances are your cash flow's gone down. All right, so keep that in mind. Also, if you're doing this in your own name, that new mortgage, the interest on that mortgage, if it's in your own name, is not a tax deductible expense. Remember that, because of the new rules that have come out, clause 24. So if somebody does this on their own name, they've got a large mortgage now, let's say it's £800 a month mortgage, which is about £9,000 a year's worth of interest. That used to be tax deductible years ago, is not now in your own name, so that would effectively be a taxable figure. Again, I'm not going to get into detail. Seek advice on that. I'm just giving you a broad stroke picture. If it's a limited company, that's different. So what happens if the market dips now? So that's the last one there. So let's say, price has gone up, you've equity release, you've raised the mortgage, and now the property prices come down, and let's say they drop down to here. Then in a situation like that, what's happened is you're in negative equity. Whereas if the price came down from, say, £200,000 down to 180,000 here, and your original price and mortgage was back here, it'd have to come a huge way down before you go into negative equity. Whereas the risk is, of course, here, it does go into negative equity. Now, of course, if you hold it long enough, in theory, it should come back up again, but it's a question of whether you want to put yourself in that position. The last thing here is, what's your long-term view? So is your plan to build your portfolio, bring your loan to values down across your portfolio? And that would be the case if you don't refinance. So imagine this situation here where we've got 100 grand property here, £75,000 mortgage. Some point in the future, it now becomes a 200 grand property. It's worth £200,000. If you maintain the old mortgage as it was here at 75,000, then you can start to see the loan to value changes dramatically here. So for example, if the value is £150,000 and the mortgage is only £75,000 because you haven't changed it, otherwise you haven't refinanced, then you'd have a 50% loan to value. At some point in the future here, it could be that if you maintain that mortgage the same across here, then the loan to value becomes 30%. And from a bank's perspective, especially if you're a portfolio landlord, overall, if your loan to value across your portfolio is lower, that does carry some weight and can give you some benefits from a lending perspective, particularly if you start going to look at lending on new properties. They may say, well, your overall portfolio is a lot lower loan to value, and because the risk profile is lower, we're happy to give you potentially a lower interest rate on some of these other mortgages. Maybe. Again, conversation to have with your broker. So it's not a straightforward yes or no answer. It depends on your long-term view. Do you want to bring your loan to values down? Do you want to keep your cash flow going up? And do you want to have that huge amount of equity in the portfolio to give you some flexibility? I mean, one of the things that can be done is secured lending against, or a line of credit against the equity in the property. So it's more flexible. So instead of you refinancing, the bank go, okay, well, your overall portfolio is at 50% loan to value. You've got £1 million worth of equity. We're happy to give you kind of an open book type lend against another 300,000 of that at this rate. So that could be something to consider. All right, I think that's all I'm going to do at this stage. Hopefully that makes sense, and the image plus the points have helped. And again, talk to your broker, but do be thinking about what the long-term plan is here. I have in the past, when I started, done a couple of refinances back in the days, 2002, 2003. And I regretted it later on, mainly because we pulled the equities right up. Sorry, we put the mortgages right up. The market then had a bit of a smack, as you know, during the recession. And it took a long time for some of those properties to crawl back up again. And I did it at the time because I didn't have a lot of capital and we were trying to squeeze money out. I wouldn't do it again. I would use a different approach this time round. So that's just a personal observation on a few of the properties that we had in the early days of our portfolio. Okay, Dr. Rowe signing out. Again, see you on the next live.